Welcome to the Explainer. Today we're going to talk about a financial headache that sneaks up on so many families, even when they have the best intentions. It all starts with a simple act of helping out a loved one, but it can end with a really stressful letter from the IRS. We are talking about the nominee trap and the infamous Form 1099. Okay, let's just dive right into a super common scenario. Picture this. You get added to your aging parents' bank account, right? Just to help them pay bills and manage their money. It's all about convenience. But then tax season hits and a Form 1099 INT shows up in your mailbox with your name and your social security number on it, reporting all that interest income as if it's yours. This, my friends, is the nominee trap. And believe me, it happens way more than you'd think.
So how in the world does this even happen? Well, the whole problem really comes down to a mismatch, a gap between who the bank thinks owns the money and who actually owns the money.
And this slide right here, it just lays out the problem perfectly. So on one side, you have legal title. That's you. Your name's on the account, so as far as the bank is concerned, it's your money. They report the income to the IRS under your social security number. But then on the other side, you have beneficial ownership. That's your parent. They're the one who truly owns the funds and gets the actual benefit. And here's the thing. The IRS follows what's called a substance over form rule, which basically means they care a lot more about who really benefits from the cash than whose name is just on the paperwork. The IRS actually has a special name for the role you're playing here. You're a nominee. And the mail courier analogy is perfect. It's like you're a FedEx driver who gets a package, that's the income, with your name on it by mistake. It's not yours. Your one and only job is to get that package to the right person, your parent, and let everyone know you did. The one thing you absolutely can't do is just ignore. And here's exactly why you can't just ignore it. The IRS has this incredibly powerful, completely automated system. It's designed to do one thing really well, match up numbers. So when the bank sends in a 1099 saying you earned, let's say, $15,000 in interest, the IRS computers fully expect to see that same $15,000 on your tax return. If they don't, boom, a mismatch is flagged, and out comes a CP2000 notice, which is pretty much the IRS sending you a bill for the tax they think you forgot to pay. Look, trying to wish this problem away is not a good strategy. In fact, waiting just makes it worse and a whole lot more expensive. The IRS has a very, very clear penalty structure for not getting this stuff right. This slide lays out what I like to call the penalty clock. The clock is ticking. The IRS gives you a pretty small window to fix this. If you correct the mistake within 30 days, the penalty is, a manageable $60. But if you wait until after August 1st, it jumps to $340 per form. The lesson here is pretty obvious. Time is literally money. Oh, but it gets worse. Here is the real kicker, and this is the part that trips almost everyone up. That penalty we just talked about, it can be applied twice. Why? Well, because the IRS sees this as two separate failures. There's a penalty for failing to file the correct info with them, and another separate penalty for failing to give a copy to the true owner, your parent. It's a double whammy for one mistake. So yeah, let's do that quick math. You've got the $340 penalty for not filing with the IRS, plus another $340 for not giving a copy to the actual owner. That brings the total potential hit for just one uncorrected form to a jaw-dropping $680. And that's before the IRS even considers if you did it on purpose. Okay. That was all the bad news, I promise. The good news is there is a very clear IRS-approved way out of this mess. It's a really straightforward two-step process to get everything back on track. All right, step one happens on your personal tax return, specifically on a form called Schedule B. As you can see here, the first thing you do is report the full amount from the 1099, our $15,000 example. But then, on the very next line, you subtract that exact same amount out. You just have to label it a nominee distribution. What's the final impact on your taxable income? Absolutely zero. This little in and out trick is pure genius. It keeps the IRS computers happy because they see the $15,000 they were looking for, but it also correctly zeroes out your income, so you're not paying a dime of tax on money that was never really yours to begin with. But hold on, you're not quite done yet. See, by reporting that nominee distribution, you've essentially raised your hand and told the IRS, hey, I was just the middleman here. And by doing that, you've just inherited a brand new legal duty. You have to act as the payer now. So step two is where you close the loop and make the data trail crystal clear. You actually have to issue your own Form 1099.
This slide shows you exactly how it works. The payer is now you, the nominee, and the recipient is the true owner, your parent. You give a copy to them, and you send another copy to the IRS. Now, everything points to the right person. Now, I know what you might be thinking. File my own 1099? That sounds complicated. But don't worry, you really don't have to do this alone. There are tons of great IRS-approved e-filing websites out there built for this exact purpose. They can handle the federal and state filings, check all the info so you don't make mistakes, and they'll even mail out the copies for you. It creates a perfect, audit-proof record that you did everything by the book.
Okay, but what if you're watching this because you're already past that point? What if that dreaded penalty notice is already sitting on your kitchen table? First of all, don't panic. The IRS actually has a safety net for situations like this. You've basically got two main ways to ask for forgiveness. The first one is called first-time abatement. Think of it as a one-time get-out-of-jail-free card if you've had a clean tax record for the last 3 years. The other path is to argue for reasonable cause. Now, this is for situations that were genuinely out of your control, like a serious illness or a major disaster. For that, you're going to need good documentation to prove you did your best but just couldn't comply.
So, if there's one thing to take away from all this, it's that we're in a new era. The days of informal family financial arrangements kind of flying under the radar, they're over. With tax enforcement getting more and more automated, following these official procedures step by step is your only real shield. The question isn't just whose money is it anymore. The real question is, does the digital paper trail prove it?